Okay, very good morning everyone. This is going to be the briefing today for the 20th of April. In today's session we're going to be talking about some of the price action we saw yesterday. Relatively tame. We did see equities come under pressure. Going to be looking at some of the reasons as to why we saw this and why your traditional correlations may have broken away. So reviewing yesterday's price action, a bit of equity weakness. We saw a leg lower in sterling currency, so we're going to be discussing that. We're then going to move on to discuss how this continued sell-off in the bond market may affect your other correlated markets, such as your FX market as well as your equity market. But let's start off by having a look through the charts and see the sort of price action we observed yesterday. So if we start off in the US equity market, just to have a quick look, given the fact that we are seeing them come under some renewed pressure early on this morning. So let's have a look at the S&P 500 and sort of see its journey over the past couple days. We had this massive rally as we started to see tensions, the trade tensions and the Syria sort of intervention and the Russia retaliation crisis start to just ease off, as we didn't see Russia retaliate. Plus further spurred on by your earnings seasons coming in nice and strong, saw this equity market break out of this range. Quite a good technical significant price point. It's about 50% of the last recent sell-off. So technical break along with sort of easing tensions and good earnings allowed the equity market just to rally. And then what we saw yesterday is a bit of consolidation. Then we started to see a bit of a technical break here of this S1 level, which is providing some support. And then we saw the market take a leg lower, only to go and recover about half its losses into the close. So a little bounce here on the close. I wouldn't have read too much into this, but this was sort of seen across all major US equity markets. We saw the Dow Jones also come under some pressure and bounce about 50%, and the Nasdaq just about the same sort of price action. What we are seeing at the moment is the equity market is under a bit of pressure. Underperformance at the moment is in the Nasdaq. It is now below its yesterday's lows, as well as the Dow Jones and industrial average is coming up to its S1 levels. So what could be causing this? Well, we're not just seeing this in your equity market, because if this was a risk move, you'd also be seeing, let's say, gold go to session highs and T-notes go to session highs on the back of safe haven flow, but that's not what we're seeing. So if we pull up gold here to start off with, gold too is at the moment on session lows. Just pushed for a new low, taking out yesterday's low, just briefly came in for a test. So gold going lower, so this is one indication that this isn't a risk move. The second indication is the fact that if you look at T-notes, which is your benchmark bond market, is also under some pressure, having found resistance on this pivot level. So to see your T-notes and gold moving lower, as well as your equity market moving lower, and your dollar also catching a bid, this means that this is a yield story which the market is concerned with. Now, if people were in the markets, well, the people in Trading Live will definitely have been here, but some of the new guys, this is not new. We were seeing this sort of at the beginning of the year, and what traders are at the moment looking at is the bond market. So I just transition across and have a look at the US Treasury 10-year yield curve. We're looking at 3%. And if we go to trading economics, this is something which I'll tell you guys to keep an eye on. If you go to trading economics, markets, and then bonds, you can see what the yield on your 10-year is for the US. So if you click on that, we're going to just discuss why this has come back into focus. So if we zoom out, we can see, let's go to a weekly chart. Now we're coming up to this technical price point. Now, as we know, bond prices and bond yields are inversely correlated. So some people are trading the yield on bonds, some people are trading the price on bonds. But if you're looking at the yield, we're coming up to one of the highest, very technically significant price point, this 3% mark. So as we're starting to see this bond market sell off in the US, well, we'll go to explain why in a moment, but people are just worried that this yield will make a technical break out of the 3% and start to rally, and this will then filter through into the rest of the bond markets, including corporate bond markets, and that will have a negative impact on, well, on the valuations of companies, because then their cost of borrowing will increase as well. Now, if we look at where T-notes are, this market has been selling off now for quite a bit of time. We're at multi-year lows here. We get the chart on a monthly chart. So last time we were trading down here was sort of back in 2011. So this is the price falling and the yields rising. Now there's a number of reasons why the price is falling. First of all, we do know that the Fed is ahead of the curve, which means they are hiking interest rates, therefore yields do need to go up. They are also tapering or they're shrinking their balance sheets. So this is taking some of the money that they introduced from quantitative easing out of the market. But in terms of why this price is going down, it's also, this could be due to people feeling renewed excitement about future growth prospects. And this would be, people are pegging this recent move due to commodity prices. And we'll turn back to commodities in just a moment. But we can't also forget Donald Trump having gone through with his corporate tax cuts, as well as his promise for infrastructure spending. This is obviously going to increase the amount of debt that the United States will need to borrow. If they need to borrow more debt, well, they they're a country which is very much in a deficit, so they will then need to raise this money through the bond market. To raise this money, they'll need to sell more bonds, so the supply of bonds also increases. So we are seeing that, following on from this Donald Trump situation, that the bonds are coming under some pressure as yields rise, and I think the story is only going to grow. I mean, he really hasn't paid much attention to his promise to start infrastructure spending, but so far he has sort of acted upon at least any of the things that he promised during his campaign. So this could be something that's coming into focus. Now that's looking at the supply side of bonds. So people are looking at an increase of supply in the coming few months. However, you've also got this metal story. So this rally in bond yields, people are pegging to the prices of commodities. And as we know, we've had sanctions on Russia, and Russia is a very large producer of commodities. This is palladium, potash, platinum, nickel, aluminium, copper, steel. This is the share of global output. So you can see Russia is a big player in this commodity space. And looking at the price, you can see the price of these metals have sort of gone through the roof as these sanctions have started taking hold in Russia. This will have inflationary effects. And if we have inflationary effects, then this inflationary premium will need to be priced into sort of your 10-year and your 30-year, which is also going to result in higher yields and therefore bonds selling off. So the commodity space is quite interesting. The danger with just looking at the commodity space is, if the United States backs off its sanctions from Russia, are we then going to say that T-notes are going to rally and yields are going to fall? Probably not, I feel. So I think it's a combination of both the supply side as well as this commodity story playing into the hands of the bond market. I do have my hesitation against saying that this is due to people worrying about inflation. If we look at what's been happening for the past week, we've had European area inflation, which was a miss. We've had UK inflation, which was a terrible miss. And I think we always exempt the United Kingdom because we have Brexit, and sterling, which I think is fair to some extent. But we are a global player in the financial market. So if our inflation is weighing, we're also heavy importers of goods. So with European area inflation going down, UK inflation going down, and if we have a look at some of the numbers we saw last night, Japan core inflation rate came in at 0.9% versus 1%, not too dramatic, but your inflation rate month on month came in minus 0.4 compared to 0.1% expected, and your headline 1.1 versus 1.5% expected. So we've seen Japanese inflation come in lower as well. So this could start building into this bigger story that we are starting to see inflation weigh across the world. Now we have some important Canadian data to focus on later on this afternoon, but I think if we start to see Canadian inflation come in at a miss as well, then I think that could be something which sort of impedes this further leg lower in bonds. But at the moment, we've been seeing not just the sell-off in the US Treasury market, but also having a look at sort of bonds here as well, just following suit. Okay, so quick here. So yeah, bonds having had a bit of a rally, falling in tandem, almost a sympathy move along with the US equity market. We also saw gilts fall as well yesterday. But what's interesting about gilts is the fact that the gilt market has closed before we had Mark Carney speak on BBC yesterday. And Mark Carney is what caused this most recent sell-off in sterling. So there's a couple technical factors. We were seeing dollar strength first yesterday, late in the afternoon. And this is something which I was pretty happy with some of the guys in stage 3 over here with, because some of them showed a lot of patience. It's very difficult to sit on your hands all day, but the people who did, they managed to catch the bout of dollar strength we saw late in the afternoon. So having a look here, we saw the euro dollar push through quite a key trend line indicating a bit of dollar strength. We saw the Aussie dollar also come under some pressure, and we also saw cable come under some pressure. But this further leg lower, this underperformance in sterling, was driven by some comments coming out of Mark Carney on BBC. And they were actually quite surprisingly dovish. Now, Mark Carney got elected as the governor of the Bank of England because of his abilities for forward guidance, so he's quite savvy with his communication, to say the least, as are all major central bankers, but Mark Carney is specifically recognised for that one respect. But what we saw Mark Carney say yesterday is like, yes, the people should be prepared for a few more interest rate hikes over the forthcoming months, but with regards to the May hike, which is only 20 days away, January, February, March, yeah, just under 20 days away. He said that he takes note of the recent weakness in UK data, which is obviously quite dovish coming from a central banker. This is retail sales coming in under market expectation, UK inflation coming in lower. Now, personally, I don't think it's that big of a deal, but you know, he did go on to mention it. He also mentioned that the views will vary in the May meetings. This is not going to be, you know, the 9 MPC members, all 9 vote to hike. So you are going to see probably a vote split. I'm not going to try to speculate what it is. Let's get some more research out before we go on and do that. So he's saying views will vary. Now, if we get 7-2 or 6-3, of course, this will then sort of give you a better indication of how people are going to vote going forward into the year. And he also mentioned that there are other Bank of England meetings as the year goes on. So, you know, he's sort of managing people's expectations there. He hasn't really said, look, we're not going to do it. I think he's still erring on the side of we are going to do it, but he's just trying to communicate with the market that, you know, if over the next 20 days he or the Bank of England isn't prepared to hike, well, this shouldn't come as too much of a surprise, because he is changing his communication in the meantime. On another note, while we're on sterling, we also saw that some headlines that EU officials are planning to reject a proposal that the UK is presenting on the Irish border issue. So this is due to this is on the backstop solution. So this is saying if in the final deal there isn't a resolution with regards to the Irish border, this is the solution that the United Kingdom wants to present, is the fact that there will be an invisible border which spans the entirety of the United Kingdom, which will give them access to the single market and customs union effectively. But this is just to avoid that border between Ireland and Northern Ireland and Ireland. The EU has basically turned around, or EU officials, the source comments have turned around and said that we're going to reject this, because we're more than willing to try to find a solution for Northern Ireland, but definitely not the whole UK. They won't be given the same privilege to say, at least in part, in the single market and the customs union, because why should they? Why should the UK have rights in the customs union and single markets if they're not going to fulfill any of the obligations that come along with it? But I wouldn't really say that this move was triggered by that. This was more triggered by Mark Carney. Maybe this rejection by the EU negotiators or senior members will weigh on sentiment more so than anything. So I think there is a clear direction here in sterling. Now, we have been rallying for quite a number of days here, or even months. After quite a strong rally, now we had inflation, retail sales, Bank of England, Mark Carney, plus a bit of dollar strength we've been seeing for the past couple of days. Which is why, I mean, my focus is definitely going to be on sterling. So if you have a look at where we were trading on European close yesterday, 1.42, we're now down at 1.41. That's a whole point in a couple of hours, or a couple of trading hours. So when somebody comes up and says, oh, what do you think about the euro? I don't think anything about the euro right now. I'm not interested in the euro. My focus is on sterling, where we have a clear directional bias. So along with this, I think the FTSE I just wanted to mention before I hand over to Sam. Well, I'm going to look at the calendar and hand over to Sam. Is becoming an increasingly difficult market, I feel, today, because initially, well, as we're seeing the US equity market come under pressure, it's going to be difficult for FTSE to rally while sterling is devaluing. So what I would be looking for is, I think, going forward in the afternoon, if we see a bit of a reversal and a recovery in the US equity market, at that point I'd be far more aggressive with the FTSE, because we'll see the devalued sterling currency coupled with a recovery in US equities means that in the sort of 1 or 2, 3 hours of maybe a bit of volatility in the equity market, I feel that the FTSE 100 will be the outperformer given where the FX pair is trading. I would like to look at it, but my system has just frozen. Alright, let's just... so at the moment you can see it's not being supported, the traditional inverse correlation between currency and FTSE. Sterling and FTSE do have quite a strong degree of inverse correlation, but this really isn't the case right now. We're seeing US equities under pressure and cable under pressure, so counteracting forces. If the US equity market makes a bit of a recovery, I think the FTSE will be the market to be looking at, as it will be spring-loaded, so to say. Alright, I'm just going to have a quick look at the calendar ahead, and then I'm going to hand you guys over to Sam, who's going to look at the markets a little bit more technically. So we had the Japanese inflation numbers. Now I'm keeping an eye on this global inflation story. We are seeing various economies around the world's inflation become a bit dampened. Okay, so looking at the day ahead, 10:30 BOE Saunders, that's going to be crucial, of course, given the fact that we had Banker Mark Carney speaking. So it really is going to see, are we seeing a united front by these central bankers to bring down the expectation for the May hike, or do we see a rather neutral comment here? So 10:30, guys, be very aware. I wouldn't be in any sterling trades at that time. Coming into 1:30, anybody trades a loonie, we got retail sales and inflation numbers. What do I think about this? Well, we've already had the interest rate decision from Canada. Now, of course, there's going to be volatility, but is there going to be anything lasting? I think not really. Definitely to keep an eye on to build up a bigger story of this global inflation numbers. So we'll do a bit more of a rundown ahead of that, ahead of those numbers. But the retail sales for sure will be interesting. 2:40, Fed's Evan is also speaking, and 3 o'clock we have European consumer confidence numbers. These are the flash readings. Now, I know these aren't really market impactful, but I actually quite like this piece of data. If you have a look at it, where it's been going for the past 5 years, it's been negative and then finally breaching zero, so positive consumer sentiment in Europe, and I want to see this trend sort of continue. More for as a gauge, but is this going to be market impactful? No breakout trading on the back of this number for sure, but something to keep an eye on. Then we'll have later on in the afternoon Baker Hughes rig count. Of course, we'll be at the office by then. But yeah, that wraps up on my side. Guys, if you have any questions, please drop them in the chat. Thank you very much, and Sam will take over from here. Thanks, Sam.
Yeah, just having a quick look. We'll start with equities, which are just not far off their lows, having just pushed back down here. Let's have a look at the S&P, not far away from where we made the low yesterday. I know still a fair bit to go. Volume not going to be at its highest for now. In terms of levels it could go to before that S1, yesterday's low would be the main sort of area you would be focusing on. We'd expect a pullback for a while before maybe we look to get a continuation later on. Into the close of the week will be interesting, where we do sort of look to finish. Previous lows of the day for S&P would be worth keeping an eye on there. For the Dow as well, you can see not too far away from that. Could get a sort of second push if you like from there. Nasdaq, nice sort of bounce from that first test of the S1. You would look to see yesterday's low here. You can see not too far away. Could now be a bit of resistance if we were to look to get a pullback there. Oil, which broke through the low of the day early this morning, only to bounce back, and I think for this to continue down, you'd want to see this sort of trend a hold or a breakthrough of that, then sort of, I mean, the volume's still going to be low, but I think if you do get a break of that trend line, it could be sort of crisis averted for oil there, which has obviously been on this great uptrend, highest level since 2014. So one to keep an eye on going into the remainder of the day. T-notes as well, the pivot has acted as really nice resistance there, and not that far away from the low of yesterday, and obviously this is the lows that we've been for some time for T-note, so keep an eye on that, and the Bund as well for those that trade. We just printed a new low, only just to bounce back briefly there. So keep an eye here. Equities just having a little bit of reversal, same as the dollar yen here, that you can see coming down, a little false breakout through the R1. So markets perhaps acting quite choppy. Important level coming up, so important to in terms of technical support, breakthrough, could act resistance. But just looking at this market here, already you can see R2 being quite choppy, R1 this morning, and then again now. So in terms of technical levels for these markets, not going to be paying too much attention to right now, but remains to be seen. Having a look over at the euro here, just again having a bit of a breather, having broken through yesterday's low. Interesting levels of support below that, and then obviously S1 would be the next sort of market related level to have in mind. The pound, which continuing this push from yesterday, decent breakthrough of yesterday's low that we had this morning, and then we did retest that. That was quite a nice opportunity, but that again just slowing down over the last sort of 5-10 minutes, sort of going sideways really since we did push to a new low. Aussie dollar, which has some support from previous, let me just move that into picture. Aussie dollar, you can see support levels from the sort of the 9th and the 10th here around the S1, hasn't quite made it down, but in terms of being a strong support area, technically that looks quite nice, even though we did break through the low on the sort of the third test of that level, but we're looking to sort of retest and come back to that now. So that'd be quite interesting from a technical point of view to keep an eye on what happens on 77.06 for the Aussie dollar futures. If we were to perhaps get a continued push to the upside, you would look at this sort of trend that we've been having in the dollar pairs, where the highs have just been getting squeezed in. So you'd want to see a break out of that for a confirmation of this move, just chilling out for a bit. Dow Jones, just keeping an eye on that as we do come up. The DAX actually now pushing to the high, so the weaker euro helping that as well. It's not a million miles away from the pivot and what was the high of the morning, so keep an eye on that. The DAX pushing on, Euro stocks as well, a bit more choppy, so the DAX looks like the one to sort of focus on there. For those sort of markets. Euro stocks obviously the highest we've been for quite some time. I think the range here you can see quite clearly just above the R1 and just above the S1, so I'll be keeping an eye on those levels really to ideally get a breakout either way to get more confirmation of where this move and could really go to. Gold, as Saif mentioned, we did push to a new low, broke a break of yesterday, but now just having again a little retracement back. So this move that sort of resembles what we saw at the beginning of February, where everything was sort of coming down, or the dollar was strengthening, so the dollar pairs were coming down, gold down, oil down, bond price and equities down. We're just having a bit of a breather now. Obviously got some relatively important data inflation wise later on in the day, so that'll be interesting, as Saif mentioned. Obviously OPEC later today, so oil, that main focus will come from then. Let's have a look if we can just start to maybe get a break of this here for oil. Not to be a couple of ticks away. If we can push through this trend line, I can see us pushing on to the highs. The pivot area is quite an interesting one today for oil. Literally to the tick on the futures was the actual original low that we had yesterday afternoon around 3 o'clock before breaking through. So I'd be expecting some resistance around there. Pivot yesterday acted quite well, and actually all week has been respected pretty nicely, so be one to keep an eye on there for oil, not just the levels we are now, but if we do eventually get back to the pivot point as well. I'm going to have a quick look over the FTSE, which has had a really good week actually. You know, the weaker pound obviously can't help in that. We've continued to push on, having opened here on the Monday. Let me just show there, you can see the Monday was a bad day before bottoming out, nice double bottom, and then we pushed above what was key support, and now we're seeing that resistance once we broke through on the 11th, and it's been pretty one directional since then, and we are the highest level we have been for quite some time, and we've had a decent push above the high that we had on the 26th. So while the S&P broke that similar level earlier in the week, the FTSE has sustained a push above once. While the S&P has just come back down. Some important points not too far away. I think if we can close above here for the FTSE, this will be really important. So where can we close the week would definitely be one to focus on here. Intraday levels, I think if we can come down a bit more, obviously the first test of that R1 has worked quite well, so if we can get pushed through there, decent opportunity up to R2 and that level just mentioned. Pivot I don't mind as well if we were to come back down. You've got the sort of the highs of yesterday all around this area. So one to bear in mind there for the FTSE. Any questions, obviously please do get them in the chat. There you go, DAX just pushing on. Helped obviously by the weaker euro as well. So the FTSE and the DAX relatively higher up than the US equity markets. Key level coming up for the DAX right about now. So was the high of yesterday afternoon and then the evening overnight session, and now we are just there you go, a little pop through for the DAX and Euro stocks as well, looking to push on. Dow Jones getting dragged higher from this, but just retesting the low. But if the DAX can keep going, you would imagine that US equities are going to push as well. But they have important levels of yesterday's lows coming up. So in terms of if you wanted to see a continuation follow through, I wouldn't be going in too aggressively here for the US markets. You would want those lows from yesterday to actually break, and then gives you that sort of confirmation that we could be looking to get a continuation. But the DAX next key level, you would say from yesterday, would be that high at R3, having broken through the trend, sort of came back towards there where the pivot level was. So the DAX just having a little push through the high of the day, continuing there. Keep an eye on US equities as they look to be dragged around by this DAX pushing higher. The dollar just coming off better levels, up 0.15%, just coming off its highs as well. Dollar yen, which has been already up down, is back to that level support we talked about, but I wouldn't really trust the dollar yen to be too technical at the moment. But yeah, any questions, please do get them in the chat, and if not, we'll catch up throughout the day. If we don't speak to you though, please do have a great weekend.